Okay, folks, let's do it. Good morning, one and all. Welcome to the Street's opening bell. The market open here from Post 35 on the floor of the New York Stock Exchange. It is Friday the 16th of September. I'm JD Durkin. I don't know if you can hear the eagerness with which the Ernst & Young crowd is currently chanting and cheering over by the opening bell here on the floor of the Stock Exchange. If you can't hear it, trust me when I say it's very loud, very enthusiastic to kick off this trading Friday. As we just said there a moment ago, the opening bell rung by Ernst & Young, this to celebrate the 2022 Entrepreneur of the Year recipients for Ernst & Young Ireland. The trading floor is packed. They're hyped and ready to go. Investors, however, maybe not so hyped. Let's get a quick check of the big board here just a moment or two into this trading day. Futures had been indicating pretty significant red territory for the major indexes, and that is true here as we cross over 9:31 a.m. local time. The Dow down, S&P, NASDAQ as well. Quick glance at the big board gives us the Dow Jones Industrial down 1.1%. At pre-market, of course, pointed to big losses to start this morning after a brutal earnings warning from the folks at FedEx, a major company here. It tanks 19% in pre-market after the company withdrew its full-year guidance. FedEx CEO saying the global economy has, quote, significantly worsened. We are on pace right now for a losing week overall, and a big one at that. We could be facing a fourth losing week among the major averages in the last 5 weeks. Let's now turn our attention and take a look at what is on tap for this morning's show. Of course, we'll be talking about the state of those major averages, why FedEx specifically here on this Friday is leaving investors so badly rattled, and how concerns of a global recession are again top of mind today. Plus, Apple heads rejoice, the big releases of new gadgets and gizmos ahead of the holiday season. I think the phrase gadgets and gizmos is officially what the company calls them. If not, it certainly should be. Okay, for those stories and so much more, let's now bring in our markets editor, our senior editor and chief markets correspondent, Martin Baccardax. Martin, obviously, I think the whole conversation needs to kick off largely with investor sentiment. Obviously, FedEx front and center. Give me your take. What is top of mind, and what retail or what any investor should be paying attention to after what has undoubtedly been a very difficult week and what could be a pretty difficult session here today as well.
Well, when you think about that famous scene in the Titanic, JD, you have, of course, Leonardo DiCaprio and Kate Winslet at the bow of the ship looking out into the sea and proclaiming themselves to be the king of the world. Now, FedEx has never said it's the king of the world, but it's absolutely at the bow of the global economic ship. And what they see in the headwinds is something that we should all pay attention to. And that's why markets are tumbling on that surprise profit warning from last night. Now, it's important for two reasons, JD. Firstly, it's only about 3 months ago that FedEx was actually really upbeat about its prospects for its 2023 fiscal year. They said they were going to see improving margins. They were very happy about end demand, and they felt as if they had gotten their management act together as a result of some activist investor pressure. That has all been washed away today because we're probably going to see the biggest single-day decline for the stock if the current moves hold until the end of the session as a result of this profit warning and the fact that FedEx has pulled its 2023 profit guidance. As you articulated, they're talking about accelerating headwinds into the global economy, softer consumer spending, softer package delivery, rising input costs, and a whole bunch of other issues that are probably going to mean weaker earnings going forward. That's pulled down some of its rivals, including UPS and indeed Amazon as well. And it's really made a lot of people rethink their prospects for not only the domestic economy, but the global as well.
I mean, I shudder to think of the fate of the Titanic. I know at that part of the movie, it was
Maybe not the
a
best
whole lot of
metaphor.
optimism, but a couple hours later in the movie and a couple days after that in real life, it's obviously, it was a fundamentally different story. I want to dive in specifically to look at the statement here from CEO Raj Subramanian of FedEx. Here's a look at what he said, I think largely to the point, as you said there, Martin, about these headwinds. The CEO of FedEx saying global volumes declined as macroeconomic trends significantly worsened later in the quarter, both globally and here in the U.S. While this performance is disappointing, we are aggressively accelerating cost reduction efforts. Now, Martin, part of those cost reduction initiatives will be FedEx closing about 90 office locations. There will be several corporate locations they're looking to close as well as canceling products. Can you help us break down that statement? And I wonder if there's anything that jumps out to you that maybe the rest of us may be missing.
Well, the one number that really was stark for me, JD, was when I was looking at the anticipation for profit margins in the FedEx Express business. Now, they have a bunch of subdivisions. They have Ground, Express, et cetera. But Express is sort of the bellwether of the group because it comprises businesses across the whole of the global economy in about 220 countries around the world. They are going to see a significant compression in operating margins in Express going into this their fiscal second quarter. And that is really unnerving for investors who are looking at not only compressed margins, but also increased cost cuts at the same time. So if FedEx isn't able to tell us right now that these cost cuts are going to improve margins, then people have to really be worried about the end demand prospects for this company and indeed the global shipping industry, which of course is indicative of global growth projections. So I was really struck by that number. I think the cost cuts are probably inevitable when you've gone to your investor base only 3 months after telling them all is well to tell them that all is not well. You have to put something on the plate in order to get at least a little bit of confidence in your investor base. And that always ends up being cost cuts, job losses, and different things like that. I just don't know if that's going to be enough to encourage the kind of confidence that management needs from that investor base, because it's just been such a short time since they were very bullish on the outlook. And of course, they've already been under activist pressure, and I would imagine that's going to continue.
You're talking about the stock for FedEx right now is trading down more than 23%. And just to do a quick update here with where the indexes are trading, the Dow down 1.2, S&P down 1.2. Tech-heavy NASDAQ down 1.6. We'll be talking about some tech stocks coming up here in just a bit. But to stick with this conversation in FedEx, Mark, can you talk to me a bit more about the headwinds in Asia that are tied to COVID lockdowns in China specifically? This has been ongoing, and not that we here in the States have been living in a post-pandemic world, because we certainly have not, but from time to time we are reminded that there are parts of the world, specifically China, that have continued to impose lockdown measures in the name of public health. But of course, there can be severe economic repercussions as well. How much of that is a part of the equation for FedEx?
It's absolutely significant. I mean, China really did only miss collapsing into recession in the first half of the year by a hair's breadth, and they're probably going to struggle to maintain any kind of growth trajectory between now and the end of the year. Numbers out today for the month of August were actually encouraging. Retail sales had a bit of a bounce, as did industrial production. But because of that zero COVID policy from Beijing and the very likely slowdown that we'll see in broader activity around the month of October during the Communist Party conference, suggests that we're not going to see the kind of rebound that people had anticipated. And that rebound is absolutely critical for not only the shipping industry, but the broader global economy as well. And I do think that's an important dynamic in all this. If we don't see that kind of China increase, particularly now, JD, when we have big events like Singles Day, which is essentially the sort of the Thanksgiving, the Christmas Day, and the Prime Day rolled into one in China and other markets in Asia. If we're not seeing an uptick in activity as a result of that, which is getting very big in the windscreen, then you do wonder where that uptick is going to come from. So I think you're absolutely right to focus on those weaknesses in Asia. And not only in Japan, and not only in China, but in Japan as well, where the government is really trying to stoke growth. And despite the fact that they have this tremendously weak yen right now, which is about at a 25-year low against the US dollar, it's not boosting exports, it's not boosting the country's trade surplus, and it's making food and energy imports increasingly expensive. That's adding to cost of living pressures there, which are going to have a negative impact on growth in, it has to be remembered, the third largest economy in the world. So we're seeing these issues and situations kind of compound in major economies and markets around the world. And that's exactly why not only is FedEx down so significantly today, but we're looking at these triple-digit declines for the Dow as well.
You just mentioned something there in your last response, and you had written about this morning over on The Street. You just mentioned their retail sales, industrial output data out of China. You used the word solid in your story for TheStreet.com this morning. And I just kind of want to touch on it in the sense that I wonder if there's any hope for optimism. Is that kind of being overshadowed? How significant is that, or should it be part of the conversation?
I think it's significant. It's not, the one robin does not a spring make, and these numbers are really only indicative of the month of August, and they, of course, are comparable to previous periods. So they were going to get a bit of a bump nonetheless. But still, anytime that you see that kind of increase in retail sales in China, it's important for a couple of reasons. Firstly, the economy, the government officials really want to slowly but increasingly change the growth trajectory of the economy away from exports and more aligned with internal consumer consumption. That's a really important change. It's been going on for a number of years, and I would imagine it will be articulated again at the National Congress in October. But what's also interesting, JD, is the fact that you have certain levels of unemployment in China that the government itself has said, if we fall below that, we are looking at potential civil unrest. Now, the numbers are a little bit debated, but they're somewhere around the 6 to 8% level. So ultimately, an economy like China simply cannot afford to slide into recession and have unemployment levels rise to the point where there is that kind of civil unrest when the government already is incredibly unpopular, and this is hard to imagine, as a result of these zero COVID policies. So in that regard, you would imagine that China is going to come up with a significant stimulus program into the end of the year if they don't get organic growth in the world's second largest economy. They've toyed, I should say, with different smaller stimulus packages. But I would imagine, again, if we don't see the kind of growth trajectory that implies a solid rebound, we'll see rate cuts from the People's Bank of China, which is their equivalent to the Federal Reserve, and probably a significant portion of new government spending from Beijing. And I would imagine all of that, if it's coming, will come out of the National Congress in October.
I wonder what the impact is that we're seeing on other major shipping names, and specifically Amazon. I wonder what this does in terms of exposing potential vulnerabilities for Amazon. Obviously, Amazon as a stock is not nearly trading down as badly, as poorly on this Friday as FedEx is. We have other parts of Amazon to talk about later on in the show, but I wonder if there's any sort of nervous, over-the-shoulder glances happening from Amazon now that we have this change in guidance from FedEx, you think?
You can imagine on a day like today, JD, investors are going to sell first and ask questions later because they can always buy back at a lower level and dollar average and actually make a little bit more money than they might have had they just held on. So I would not be surprised to see it down about 3, maybe even a little bit more percent by the time we get to the end of the session. Much will depend on what happens with bond yields, but nonetheless, we'll definitely see weakness. There's always a debate about what portion of FedEx's business is linked to Amazon, and the two companies themselves do try to downplay their reliance on one another. But I do believe that a big portion of the decline for Amazon today is simply the assumption that they are both important components for one another, and therefore you're going to see weakness in the stock as a result.
The CEO here also expects, he said, a worldwide recession was the phrase that was used. And I want to move the conversation a little bit more broad off of FedEx to what this means sort of globally. Martin, correct me if I'm wrong, there doesn't appear to be a ton of confidence in a soft landing. Is there a strong argument that between inflation, the unenviable position that Mr. Powell finds himself in, that we can actually get to that soft landing? Because comments like this don't really seem to indicate that that's a very strong possibility. How do you view it?
I think you're absolutely right to tee up that concern. I think the engineering of the soft landing is now in significant doubt as a result of things that have really only changed in the last 2 or 3 days. Certainly when you look at the broader context, you have U.S. mortgage rates past 6% for the first time since 2008. You still have some of the highest consumer price inflation in more than 4 decades. Gas prices are tumbling, but they're starting to slow in terms of their decline. And whilst they are on a downward trajectory, they're still significantly higher than they were this time last year. Companies are laying off. Companies are trimming their earnings guidance. And of course, the Fed has told us that they are going to continue to raise rates until they are very comfortable and indeed see compelling evidence that inflation is slowing. None of those components indicate to me the kind of economic recovery that people were pricing into stocks in the early part of the summer. And therefore, that soft landing is now increasingly in doubt. What we saw yesterday was the World Bank issuing a report saying that effectively, because central banks are so focused on fighting inflation, they're starting to choke off growth. And you don't often see the 3 biggest economies in the world, China, the Eurozone, and the United States declining at the same time. And because they are, the World Bank has essentially said they're seeing some of the steepest declines in broader conditions since the early 1970s. They're predicting a recession in 2023. And I think, JD, a lot of other analysts are lining up behind them to do exactly the same.
Of course, not just FedEx. World Bank sees a higher risk of a global recession in 2023. We heard that a few days ago. They say global growth is falling sharply. Why wouldn't, for someone looking at this from the outside with maybe a loose familiarity, Martin, why wouldn't simultaneous rate hikes, which we have here, we're dealing with in Europe, we're dealing with in other economies as well, why might that not be enough to bring in inflation back down to earth a bit?
Yeah, it's ultimately the question as to what is the origin of the inflation. And there's still a significant debate, certainly here in the United States, but also elsewhere, as to what was the principal driver. There are those who will tell you that it was government spending and fiscal stimulus in the wake of the pandemic that essentially increased the budget deficit and therefore stoked demand to the point where consumer prices just started to skyrocket. There are other people that say, well, listen, the government's been running budget deficits since, God was a boy, effectively, and have been doing so for the last 10 years at the very least. And there hasn't been a whiff of inflation until we saw supply chains unravel as a result of the pandemic, particularly from the lockdowns in China. So that debate rages, but nonetheless, central bank reaction functions have stayed the same. They're always going to do what they do, and that is take the inflation hammer and wield it with as much strength as possible. Now, the timing of everyone's rate decisions have been different. The European Central Bank lagged a little bit from the Fed. The Fed lagged market expectations, and the Bank of England is playing catch up right now. But irrespective of the timing, everybody is now moving in the right direction, or at least in the same direction. Now, the question is whether they're going to move so quickly as to choke off growth, because we don't particularly understand or haven't come to a consensus as to what drove inflation in the first place.
Mark, we're going to shift the conversation over to Apple. Obviously, it's a big day for Apple. But first, before we do, much like you and I did a few days ago during that huge sell-off, I just want to give you the opportunity to highlight anything that maybe you and I have not had the opportunity to yet discuss that either was top of mind for you as you filed your stories this morning for TheStreet.com, or that you think investors might want to keep in mind as we head into what certainly looks like another very volatile session to end, quite frankly, another volatile week.
Well, I think you're right to highlight that, JD. And the concern for me is the fact that the volatility index, the VIX, VIX is the ticker, is one of the benchmarks that we look at in order to understand what kind of intraday market moves that we're going to experience. Now, the VIX is at a reasonably elevated level, but historically it is still quite low. And because we are getting significant declines, even with a low volatility gauge measure, that tells me that markets are repricing rather than just trading. And that's a significant change to what we saw throughout some of the summer months. So I'm a little bit worried about that. And I'm also worried and focused on what we are seeing in the bond markets. We have a 3.91% yield on benchmark 2-year Treasury note yields. Now, in the main, that probably doesn't mean much to anyone, but it's worth recalling that it's the highest level in 15 years. And 2-year note yields are about 45 basis points, or nearly 0.5% higher than 10-year Treasury note yields. That means that the yield curve is inverted to a significant degree, and that nearly always signals recession for Wall Street professionals. So even if the recession doesn't materialize, the dynamics in the market suggest that it will, and traders will indeed take their key from that. So I will find it very difficult to see a way in which stocks can recover when we are looking at declines in low volatility and an extremely inverted yield curve. And that, to me, spells a difficult September and certainly puts a lot of pressure into the Fed decision on Wednesday afternoon.
Of course, many people refer to that as the fear index. It is up right now almost 6%. It is one of the key data figures that is quite literally featured on the big board here at the New York Stock Exchange. You can glance up at any time and see where it is, and oftentimes has that inverse relationship with the major averages. Okay, let's talk Apple. Tim Cook was here in New York City earlier today. That's always like an exciting thing for Apple fans. He's up at the flagship store up by Central Park. Everyone waits. He waves to the cameras. It's all very nice. He's, of course, here to help kick off the new Apple products. We talked about this a few weeks ago when they were announced. I actually thought the presentation was very cool out of Cupertino. Like, it really kind of kept you engaged. And I think Martin, you and I joked like I don't scuba dive, but like I really want to get the new Apple Watch just to learn scuba because it made it look that cool. New iPhone 4 or 14, the Pro, the new Apple Watch. What do you think will be the top headlines when the dust settles after another day for the folks at Apple today? A big one.
It's a fun one, isn't it? I'm always amazed, and I really do admire Tim Cook's stewardship of this company. It's so hard to follow a legend, as you know, anybody who follows sports understands. When you come in and take over a team that's been led by a coach for a number of decades, there's almost always a decline, and then a second person comes in after you and cleans up the mess. And I think a lot of people thought that Tim Cook's taking over from Steve Jobs was going to be exactly that, and it was nothing of the sort. He has done an absolutely just unbelievable job in leading this company, driving it into new innovation, driving it towards new markets, and creating growth where really it didn't exist prior to him taking over. So seeing him this morning, seeing the energy that he has and the way that people respond to him was really, really interesting. And to me reflects the kind of association that a lot of investors and customers have with a company like Apple and how unique that actually is. But JD, to your pointed question, the thing that I'm most focused on right now are the pricing levels of all of these 4 new iPhones. They range from around $800 to around $1,100. And that is essentially the same as we saw the pricing structure for the iPhone 13. That tells us one of two things. Either that Apple doesn't believe that people were willing to trade up to the new phone because it doesn't have enough new bells and whistles, or even more importantly, it doesn't feel that consumers are prepared to pay a higher price for a better product. And that is really significant because if Apple doesn't have pricing power, who does? And that is an important dynamic in a market that is now just, of course, gripped by inflation, but where investors are looking for companies and companies only that have pricing power. We don't know yet if that's the case with Apple, but the fact that there wasn't a price increase at least raises the question. And for me, that's the most interesting thing from today and indeed going forward.
You know who's a bit of an anomaly to that idea of the sequel not being as good as the original coming up and cleaning up? Aaron Rodgers, right? I mean, you're coming in after in Green Bay as the quarterback. Brett Favre is the ultimate Iron Man, a living legend, one of the best to ever do it. And the unenviable task of being first to back up and then to take over a franchise like the Packers and then have a Hall of Fame career the way Aaron Rodgers has done. Aaron Rodgers, kind of the Tim Cook of football. I don't know. What do you think about the comparison off the top of my head? That's
a great comparison. There's not a lot of precedent for that sort of thing, is it? I mean, it's often joked that the most popular guy in any city is the backup quarterback. I don't know that that was the case in Green Bay when that switch was made because Favre was so popular. But it's unquestionable that the team just went to a Super Bowl, won a Super Bowl, and has done tremendous things under Rodgers. And even though the fan base gets a bit irritated by him at times, he served that city well.
Well, here in New York, we got Tyrod Taylor as the backup to Danny Jones for the Giants. I think Giants fans are okay with Danny Jones after the first week, but I've been saying that at some point the calls for Tyrod Taylor be splattered all over the tabloids. I do want to stick with Apple here, of course. I think we're torturing the metaphor
a little bit when we're talking Tyrod Taylor and Danny Dimes.
Yeah, for sure. Yeah, exactly. We'll stick with the Packers. A much better comparison for the strength of Apple. To this point about Apple, I wonder what we know. How has the stock historically performed in this window between these anticipated September or early fall hardware announcements and the heart of the holiday season, right? This is such a crucial time for Apple these next few weeks and months. They make these announcements, they get the excitement going. People are buying these hardware for themselves and their loved ones. What do we know with regards to how the stock has historically been, and does that give us an indication to what we might see in the coming weeks? Of course, we're dealing with a whole set of factors we really haven't before.
No, it's an important question, and the stock has usually gotten a post September launch lift. It hasn't been significant, but it's been consistent. And I think now the fact that that's in question is interesting for me as well. But against that, JD, we talked about this last week as well. Apple is now the most shorted stock in the market. In other words, investors have the largest amount on a dollar basis of bets against Apple of any other company on the S&P 500. Now, to some degree, that's logical because Apple is the biggest weight to the S&P 500. But the fact that Apple has overtaken Tesla as the most bet against stock, I do think is significant because it probably represents Apple as a proxy for the broader market movement. And therefore, people are maybe just deciding to use that as an easier way to bet against stocks. than the broader indice itself. But I do think that the fact we are seeing that, we are seeing questions about Apple's pricing power and larger questions about consumer demand, which was reflected in FedEx this morning in the retail sales data from earlier this week, and the surprisingly fast August inflation reading. All of that comes together to really question the demand component for Apple going into the end of the year. So that it might be difficult to repeat this time.
How does our previous conversation of a possible, if not likely, global recession impact Apple next year specifically? I got to imagine your big companies will really be hit. Will Apple be one of them?
Apple has some resilience, and for a bunch of reasons. Obviously, we talked about the relationship between consumers and products and the company itself, but also Apple has tremendous breadth in terms of the geographic regions in which it generates revenue. Plus, it has a services sector component, which doesn't rely on people upgrading into new phones and new computers, and that's one of the fastest growing. So, and then further on top of that, Apple has a tremendous cash pile. It has all sorts of ways in which it can manage any kind of decline that it might see in the share price. It can buy back, it can boost dividends, it can engender investor confidence that way. So I wouldn't say that Apple is necessarily a company or a stock that would perform in a significantly different way to the market as a result of bets on a near-term recession. I think it's a little bit more resilient than that, but that doesn't mean it's bulletproof.
Absolutely. Okay, time now for our rapid fire section as we get through a few other topics. And thank you. What a great substantive conversation that other one was. Okay, let's talk GE, because this is really interesting. Martin, first up, is GE in for a bumpy end of 2022?
Yeah, I think they absolutely could be. Cash flow is one of the most important metrics to look at if you're considering or indeed have an investment in GE. Their cash flow forecasts are critical for stock price movement. And the CFO yesterday talked about the fact that supply chain disruptions are making it difficult for GE to deliver products to customers. They actually might have to delay some of those deliveries into the fourth quarter of this year, and that as a result is going to pressure their cash flow generation in this quarter and potentially into the end of the year. GE is also dealing with a surging US dollar, which is a headwind to the revenues that they generate in markets around the world. And indeed, GE is a very cyclical stock with respect to the prospects of the global economy. So altogether, there are more bumps in the road, I think, than a smooth path, and that's why you're seeing the stock down. The last I checked, about 3 to 4% in early trading.
Okay, next up, let's talk Uber. Should users of Uber be concerned about the company being hacked? This might be the first time people are hearing of this.
Yes, indeed. This is an interesting one. It's reasonably high profile. What we understand about it right now, though, JD, is that it was, whilst disturbing, it didn't appear to be that serious. A hacker looks to have compromised the IT systems of Uber through a Slack channel. Essentially, they posed as a corporate IT executive. They were able to get a password out of an Uber employee, and then they were able to use that to infiltrate systems inside the ride-sharing company's broader communication systems. That was disruptive yesterday. The company itself essentially had to confirm a New York Times report rather than making it public themselves. That's never a good thing when it comes to security breaches, because it echoes back to what happened in 2016 when there were significant amounts of intrusion on driver data and other things. And the company was, well, let's just say slow-footed in warning investors and indeed regulators about that. So I think the fact that this was a little bit of an echo to that was probably more of an indication of why we saw the stock trade down than the actual hack itself, which seemed to be a bit more of an irritant than a broader and significant security concern.
All right, fourth and finally, National Football League making its big Thursday Night Football debut last night on Amazon Prime of all platforms. Martin, was it a hit or a miss?
I think it was. I think it was a hit. $1 billion experiment from Amazon, and that's small potatoes for a company that generates the kind of revenue that they do, was on display last night. It was the first time that a regular season NFL game has been streamed on a platform like that. It was live broadcast in the Kansas City and Los Angeles markets as a result of an agreement with the NFL, but it was online for the rest of us. And the product was really good. I think the graphics were solid. Al Michaels and Kirk Herbstreit are probably the two most respected NFL broadcasters out there, and they were fronting the game, and that was entertaining. The game itself was fantastic. Just a really compelling struggle between the two teams, and we had the great defensive interception near the end of the match. So I think everything went pretty much as well as it could for Amazon. There was a little bit of sniping on Twitter about lag times and graphics and various other things like that. But for a debut of that proportion on a Thursday night when there was nothing else competing against it, I think they did really well.
Well, I will say the Mets-Pirates game was competing against it, but I don't think very many people were interested. Based on the crowd at Citi Field, I got to tell you, not very many people were interested in going to the game either. For what a special season the Mets are having, I was like, where's the crowd here for this game? But I was, like I said, I was at home watching or I should say I was at the game watching the Chiefs game on my phone on Amazon, like we said. Martin, I must apologize because I missed one very crucial question in our rapid fire. So we're going to go back to that. Is the United States ready for a digital dollar? Yeah, a little rewind rapid fire here today. Is the U.S. ready for a digital dollar? Great question here.
This is a fun one. Effectively, the White House back in March issued an executive order in which President Joe Biden said, listen, we've got to get our act together on cryptocurrency regulation, and I want everybody around the cabinet to form a study and come back to me with suggestions about how we can best do it. Now, there were 9 studies that were given to the president as a result of this, and the most interesting one, I think for most, came from the U.S. Treasury, where they said we should probably accelerate the move towards the digital dollar, which will effectively be a sort of Treasury and Fed-controlled currency that is entirely digital, that will compete to a certain degree with some of the crypto currencies that we're seeing expand in markets all over the world. The U.S. is a little bit behind some of the other countries in doing this. China has made a similar drive a few years ago, and we still probably are a long way off. But the fact that the country and the Treasury is on board with this is probably the most significant move we've seen in that direction. So I would imagine we're looking at a 10-year project now, as opposed to maybe a multi-decade one just a few months ago.
Okay, the great Martin Baccardax, thank you for taking the time. Okay, before we wrap up here, any big, bold predictions you'd like to make about the rest of the NFL slate of games coming this weekend? Your Dolphins have Baltimore, if I'm not mistaken. Is that correct?
We are absolutely at Baltimore. No, excuse me. I think it's at home, and we are a 3.5-point underdog, as I understand it. But everybody's healthy, and this will be a really interesting and early test for probably, the betting, the darling of the newcomers, I guess, if you will, of the NFL season this year, and that's the Dolphins themselves. But do you want to bet against Lamar Jackson? He's coming home because, of course, he's a Miami native, and he always does play well as a result of that. So for me, although I'm biased, that's going to be the interesting game of the slate.
It's hard to bet against a home dog, though. I like home underdogs, right? They tend to kind of get in there and get gritty and walk away with a win, at least cover the spread at the very least. Well, I wish your beloved Dolphins the very best. I thank you for another fantastic week of morning shows here, Martin Baccardax. Thank you for the perspective and helping our viewers understand what this dizzying array of market stories mean for them and, of course, their portfolios. Martin, thank you. Have a fantastic weekend. That'll do it here for Opening Bell here from the floor of the NYSE. Stick with TheStreet.com for more on these and every other major market story that mattered to you. We'll see you later. Have a great weekend.